All right, there are three different kinds of liabilities. The liability types are either known, or they're estimated, or they're contingent upon something else. So a known liability is something that we know what the obligation is, we know how much it is, we usually know when it's due. An estimated liability is an unknown amount, but it's likely that it's going to occur. So we're going to go through some examples. Don't worry about that. I just want to get you comfortable with the types of liabilities we'll be talking about. And then the last type is the contingent, which by the nature of it, the name means that it is contingent upon some future event happening or not happening. So, all right, here we go. So the first one we're going to talk about is a known liability, and you'll always be able to keep track of where we are because I've put a little thing up in the corner here to just kind of map out what we're doing. So the next following slides are going to be all about a known liability, meaning we know the liability, we know the amount, we know when it's due. So one of the types is a current liability, meaning that it's due. So the amount that we owe is due within 1 year or one operating cycle, whichever is longer. So an operating cycle means what is the cycle that it takes me to produce revenue. So if I'm a winery, then it might take me longer than a year. So I may have an operating cycle that spans the amount of time that it takes me to make that wine. So that's just an example of what we mean by an operating cycle. But for the most part for this class, we're going to assume it's a year. All right. And then we have long-term liabilities, and those are due longer than a year from. So the other kind of a short-term liability, a known liability, would be sales tax payable. So for those of you that live in California, you know that we pay a nice hefty sales tax. So we are normally thinking about it on the consumer side, but a business, when they collect the sales tax from us in addition to the price of our goods or service or our product that we purchase, then they need to make a separate entry for the amount of tax that they collected, because eventually they're going to need to pass that tax along to the government. So that is not revenue that they're earning. So you can assume here that we're using an example that I bought lunch at the airport for $15, probably a nice sandwich, and we have to pay a sales tax at 10%. Now I know that's not really realistic. That's a little high. I think in California we're up to like 8.5%, but you get the idea. And it's an easy computation to use 10%. So that's why I did that. Okay. So when the airport sells you that sandwich, the journal entry would be they take in $16.50 from you, and then the revenue they earn is the $15 for the sandwich, and then they have to put the sales tax into a sales tax payable account, which is a separate journal entry. So it wouldn't be fair for them to say, oh, I just made revenue of $16.50, when really they didn't. They actually have to pay the government that $1.50 for the sales tax. Another kind of a short-term liability would be payroll taxes. So you and I have been paid payroll before, and if you've ever had a chance to look at your pay stub, you have something called gross pay, and then you have something quite a bit smaller down at the bottom that's called net pay. So what goes on in between are the payroll taxes. And as an employer, because remember we're recording everything as a business now, the employer actually has some costs in addition to collecting taxes for the government. So we're going to go over a journal entry to see how that looks. And also on this slide, I wanted you to know that there's some more details about the income taxes if you're interested in that kind of thing in the notes part of this PowerPoint, but I am not going to be going over that in too much detail. You can take a whole class just on payroll. All right, so now I'm going to give you an example. So let's say we've got Hawaiian Travel Agency, and they have total payroll for all the employees that they hire of $100,000 for its 20 employees. Okay, so their federal and state income taxes that are withheld, that they have to withhold on behalf of the government, are $24,000. They may pay some health insurance premiums to keep you insured, and they may also help match or pay into a retirement fund for you. And so I've just given you some examples here. And then here's a FICA tax rate for Social Security and Medicare that they're required to pay, as well as unemployment. So what does the journal entry look like? They have salaries expense of $100,000. Remember, that's what they were paying their employees. And what do they do with all of this? So part of that money is going to be put into an income tax payable account, because that's the amount of federal and state income taxes that the employer withheld on behalf of the government. And so they have to withhold that from you and then pay the government. So that goes into an income tax payable account. And the FICA tax payable, similar kind of a situation. That also gets recorded here, and then I just gave you the format of how I calculated that. So I took the $100,000 times the FICA tax rate, which just for this example, I don't know if it's gone up or down since I've made this slide, is 7.65%. And then they have federal and state unemployment taxes that they have to collect. So anyway, so the salaries payable, just to balance that out, would be $68,000. So all the others are taxes that they owe. Okay, so another kind of a known liability that's also a current liability would be the current portion of a long-term debt. So let's say I've taken out a 5-year note, and it's for $45,000. The interest rate is 7%. I owe $9,000 of that plus the interest every single year. So this is kind of similar to like maybe a mortgage on your house, where you took out a big loan and then you pay on a monthly basis. In this case, it's slightly different. It's a note and they're only going to pay once a year, but you kind of get the idea. So my point is that there's going to be a current portion of that long-term liability. In this example, that would be the $9,000 of the annual payments, and then the other portion would be listed as the long-term liability. So my point to you here is that you could have a long-term liability, but if you have a certain portion of that that is due within a year, that portion that's due within the year is considered the short-term liability. So I've kind of drawn a little map here, so hopefully this helps. So the current portion of a long-term debt would be what was due in that current year, because remember our we take it on a yearly or an operating cycle, so that's the current portion of our liability. And so whatever the current portion of that long-term debt is would be considered that current liability, and then everything else would be listed as the long-term debt. Okay, so what else do we classify as a current known liability? That would be deferred revenue. So deferred revenue sounds like kind of a funny thing, but in this case, if we're a business and someone has paid us cash in advance of us giving them the good or the service that we owe them, then that money that we take in is a liability to us until at which time we perform that service. Okay? So an example I give you is there's a catering company out there and they've signed a contract to cater a wedding that's going to be happening. So the funds are received on May 1st. Okay, this is kind of old, for 2011, and they're not getting married until the 12th, but they received $3,000 in advance, which is a very common thing to pay them before the wedding to commit, so that they know that they're actually going to cater the wedding. So anyway, that is what we call deferred revenue on the part of the caterer. Okay, so they're obligated to cater the wedding. They've received the cash up front. So in this case, we're going to take in the cash on May 1st when the couple pays us the $3,000, and the rest of it goes into an unearned revenue account. Now you notice that that is a credit, and that makes sense because we increase liabilities with a credit. So this unearned revenue is a liability to us until the wedding day, and we cater the wedding, and then that unearned revenue gets debited and revenue gets credited, and that's how that whole transaction turns out. So here I've given you the example of on July 12th when the wedding is, and they've actually catered the wedding. Here's the unearned revenue that's being a reversal of this, and then here's my revenue that is going to be credited, which increases my revenue. Okay, so now we're going to move on. Those were some of the known liabilities, and I also gave you a summary slide, which I'm not going to go over this would take me an hour to get through. So the next one we're going to have are estimated liabilities. These are liabilities, meaning we are going to be liable to pay something out, but we don't exactly know how much that's going to be. So a typical example of an estimated liability would be a warranty liability. So you can imagine that HP or Dell or a computer company, when they manufacture a computer, they've got to set aside some money, knowing that not every single computer is going to be working flawlessly and there won't ever be a warranty on that. Sometimes you're even encouraged to buy an extended warranty. So that's the idea behind an estimated warranty. So for someone that manufactures a good, they don't exactly know how many are going to be returned or how many are going to fall under the warranty period where something needs to happen with that, but they can reasonably estimate based on previous years how much of the amount of revenue is actually going to need to be covered under that warranty. So that's why we call these estimated liabilities, because we're pretty sure they're going to happen, we just don't know how much. So in the example I give you here, there's an auto parts store and they make sales of $45,000 during the month, and they extend a 90-day warranty on all their products. So they estimated that 3% of its products will require warranty repair. Now, where'd they get the 3%? Well, like I mentioned before, they might get that from the history that they've had over the years. And so when you do a problem in this class, you will be given that percentage that they think will be needing repairs. Okay, so what happens here? So if they sell $45,000 worth of stuff, they're going to take in either cash or accounts receivable. That part doesn't really matter to us at this point. And they write it all down as sales revenue. But then at the same time, they also make an entry for what they think might be the warranty expense. In this case, they're going to take the 45 grand, multiply that times 3%, meaning that 3% of the auto parts that they sell might come back to them and they might need to repair those. So there's going to be some money involved on the part of this auto parts store to repair the part. Okay, so then I have an estimated warranty payable right over here that's going to stay. And this way, if you'll notice, what's happening is that I've got sales revenue over here and I've got a warranty expense that's going to be matched up with that revenue. So I made all of this revenue, but I also am likely to incur this $1,350 in expenses as a result of making that revenue. And remember, we match up all of the expenses that are required to make that sale, and in this case, warranty expense would be one of those expenses. And then we tuck the rest away into a payable account until at which time the repair needs to happen, which is what we're going to talk about now. So assume that during September they paid $175 for a warranty claim. Customer came in, said my part's not working, I need it fixed, I want a replacement, whatever. So in this case, for the $175, now they're backing out $175 out of the payable account. Please notice that the warranty expense account has already been debited and is not dealt with at the time that the repair takes place. Okay, and in this case, I guess they refunded the customer for $175. Okay, so if the customer comes in and says, you know what, I just want you to fix it, I don't want my money back, then what would happen is I would still make that debit to estimated warranty, but now I'm just going to take a new part out of my inventory. So here I'm going to decrease my inventory and give them a new part. So that's how we true up our estimated warranty liabilities. Okay, and the third type of liability that we're going to talk about is a contingent liability. And as I mentioned, the name itself kind of gives it away. We don't have this liability documented right away because it's contingent on something happening. So it's unique because it could have been a past event that's going to that this liability is arising from, but the amount or the certainty of it is dependent upon a future event. So you can kind of think of this as like a pending litigation that might be happening against a company, and the company doesn't know if the ruling will go in their favor or not. And if it does, they don't exactly know how much will be awarded to the person that's filing a lawsuit. So the definition of this is it's an existing but yet uncertain situation, and it might result in a loss, but it depends upon something that's going to happen in the future. So what the heck do we do with those? Well, here's a little happy table that will kind of tell you what to do. So if the likelihood of the loss is remote, it's very unlikely, meaning that, okay, someone's filed a lawsuit against us, but maybe it's frivolous, okay? And so the chances of them winning is pretty remote. So in this case, what do? Well, we do nothing, okay? And on the next level, getting a little bit closer, if it looks like someone's filed a lawsuit against us and it's reasonably possible that they may win, but we don't know how much is going to be awarded, and we don't, it's only reasonably possible. Okay, so these terms are really important. And in that case, we don't make a journal entry. We actually just put it in the footnotes of our accounting statements. And if you've ever looked online at anybody's 10K or their balance sheets or whatever, there's always these footnotes in there, and they're fascinating to read. So it could be that that there's a likelihood of a loss and it's reasonably possible, you may see something documented in the footnotes of the financial statements. All right. Now, if the likelihood of the loss is probable, so it looks like it's going to happen, and if we can estimate the loss, meaning that maybe the lawsuit's going to be between $1 and $1 million, then we're going to put in a journal entry, and we're going to also put that into the footnotes. But if it's probable, but the estimate cannot be, the amount of the award cannot be estimated, we'll put it in the footnotes, okay? So these are important distinctions for you to make.